Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
What's up, everybody? Anthony Crudele here, and thank you for tuning in for this episode with George Goncalves. Futures Radio Show is sponsored by CME Group. They are the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. Remember, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes, YouTube, Google Podcasts, Spotify, and Stitcher. If you're enjoying the show, please leave a review on iTunes. This show is also sponsored by Trading Technologies, FTSE Russell, and RJO Futures. To learn about some great offers that these sponsors have for our listeners, please visit futuresradioshow.com/sponsors. Today I spoke with bond strategist George Goncalves. George kicked off today's show by giving us a detailed recap of what central banks have done since the coronavirus. He tells us why he believes that the Fed has gotten better at dealing with financial crises and explains why the dollar is currently faced with a curse and a blessing. And we talked about how both the dollar and gold may be headed higher together in the short term, but the dollar is probably headed lower in the long term. We discussed Treasury market dynamics, credit markets, and last but not least, George gives us his best and worst case macro scenarios going forward and shares with us a chart that tells him that the market may not be done searching for a bottom until April or May. So without further ado, let me take you right to the interview with George. George, thank you for coming on the show on a Saturday.
Anthony, a pleasure to be here. Thanks for inviting me.
Well, it's great to have you here and a lot to talk about today. Been following you on Twitter for some time, learning a lot from your feed, and really shedding light on a lot of topics that are really impacting our markets right now. So thank you for all the content that you've been putting out there. And with all that being said, I don't know a ton about you and your background. So I wanted to begin today's show with you just sharing with us a little bit about your background. So this way we know where you're coming from with a lot of the topics that we'll be discussing today.
Yeah, sure. Listen, I'll go way back really because I think it helps provide some context. Because I'm usually pretty much a straight shooter and do speak from the heart. I'll go way back to before my professional experience and give a little background of who I am and my family. To be honest, we came to the U.S. from Portugal. I was firstborn generation, first person in my family to graduate from higher education, first person to make it all the way up to the top and become an MD at a large investment bank. So really fully value the concept of hard work and dedication, and being honest with yourself and understanding where your strengths are, your limits are, and continuing to go back and fine tune them. And over the years, after coming out of school, I started out at a which was formerly Merrill Lynch Asset Management, now part of BlackRock, and learned the plumbing of the system. When I started, 10-year rates were well above 5%. Feels like ancient history. With rates now flirting with zero. But spend time on the buy side, understanding how trading gets done, understanding how to manage risk, but really learning the money markets, which really proved to be so invaluable both in what I experienced in 2008 and 2009, as well as what we're experiencing right now. After that, spent some time in various different broker dealers, as a chief strategist and senior strategist on the bond side, and for almost nearly a decade up until recently, I was at a large broker dealer called Nomura Securities, and I was their chief bond strategist at that time.
So your primary focus is on the bond and credit markets.
Yeah, that's right. And you cannot do that without having a full understanding of all the cross-market correlations and having a good handle on macro and what the Fed is doing.
Yeah, no, absolutely. And so today I'd like to just kick it off with talking about the central bank action. So much has happened, right? I mean, I'm somebody who likes to always listen to everything that's going on and just really develop a theme. And what's going on right now is it's overwhelming. I mean, there's just so many things that are happening. And I'm really curious to hear from you. Just basically give us a recap of what the central banks have done thus far, and maybe tell us what is left in the tank after this, if maybe this doesn't work out the way that they think.
Yeah, I mean, central banks have definitely gone wild. I mean, I think they learned their lesson from 2008, 2009 that you have to kind of hit it hard, and they're definitely doing that. I'll focus on the Fed, but quite frankly, everything I'm going to describe, it's like global now. Like every central bank is basically performing some version of QE. The Fed basically perfected what the Bank of Japan created multiple decades ago. QE. You've had the Bank of Canada that's joined, RBA, down in Australia. I mean, everyone's doing a version of bond buying, but nobody beats the Fed at QE. So like we'll go into QE in a second. But before they got to QE, they basically have relaunched all of their global financial crisis era tools. I mean, the alphabet soup of all these different liquidity warehouses, which are really meant to kind of help with market function and prevent like a shortfall in liquidity. They've relaunched all of them and then some. They've slashed rates down to zero. In many ways, I start to wonder, was like 2008 a trial run for what they're doing now? Because they were so much better at it this time than they were, in that crisis. And then, if you look at the real new bazookas, is that they're doing QE at a speed and a size that, I mean, it's just unheard of. I mean, there were, the Fed's balance sheet last week, I mean, not just the bond buying, but just in general, went up 600 billion. I mean, we hear billions and trillions getting thrown around now a lot lately, and you kind of start to like lose track of what those numbers mean. But basically, the buying that they did in roughly in a week or so was equivalent to what they did during QE2, and we were impressed back then by all that buying. So something's definitely going on. They're doing an encore to the old QEs and just doing more of that. They've also now created a program that allows support for the credit market, which is going to be important, and to see how that works out. But with all these things though, and I think what we're starting to realize, and the Fed even themselves are starting to realize, there's unintended consequences. I mean, this is you don't just do this lightly. I mean, they're really trying to keep market function going. But sometimes when you flood it too much, you can like flood the engine and stall out. And I think that they're worried about that. And then I guess what's left, I mean, there's a number of things that they can still do. But I think this is, the current crisis is a health crisis. We have to kind of acknowledge that and face the reality that until the numbers improve and things get better on that front, what they're doing is just buying time, these central banks and fiscal action. But what they could do and what's left, I mean, I really hope that they do not buy equities, and that they can manage with all this liquidity to provide some stability. And we kind of we look forward and we still have one area of capitalism that's fully functioning. On the equity side, they could peg rates like Japan has been doing, like you kind of anchor rates. I'm not a fan of that either, but it's within their wheelhouse to actually lock in rates to help the government fund all these programs so that we can kind of get to the other side. Probably support munis. I mean, there's some news over the last couple of days that the Fed has hired a muni banker. Okay, so maybe they're going to support the muni market. That's an important part of the fixed income market too. And then then it starts to really go down the rabbit hole, and it starts to get into the more evil tools, which I don't really like, which is like negative rates, forcing bail-ins on banks. It starts to get really ugly over there. So I'm gonna, that's a moment where you have to cover your kids' ears. You don't want to hear that. And I think that's basically it. I think we're at that juncture where they've done a lot, and there's a few more tools left, but they start to get really into areas where I think they don't want to go.
So a few thoughts after hearing you give a recap. One thing that really stuck out to me in what you had just talked about was you said they got better at it. They're better at this. Could you go into a little bit more details of why you think that they're doing a better job now than in the past?
Well, I mean, I think that they've been preemptive all along, even prior to this, by doing the insurance easings that they did last year, they learned through the, which I didn't go into, but it's also a part of their toolbox. The repo debacle that we saw all throughout, the fourth quarter of last year and the early part of this year before we got into this, downdraft. They've learned the pressure points in the system, and they're trying to really fine tune it and hit it harder than before. So, you have to applaud them for that. But with everything, there's a certain threshold, I think, that where even folks like myself would say, hey, like, you're going a little bit too far. You don't want to, become the market. You want to allow market forces to kind of work their way through. But they've basically have their hands on like the dike, holding, to make sure the water doesn't kind of come through. They have basically the dam holding back the dam in a way that they've never done before.
What were your thoughts on the market's reactions after some of the things the Fed has done?
The thing is, especially how vol's been trading and what, on the one hand, you have like central bank support, which for nearly a decade, there's been a whole generation of traders that have assumed that, central banks got my back, therefore that things will always snap back very quickly. And so I think what really surprised and caught people off guard was that even with these unprecedented actions, the speed of how they've kind of tackled some of these issues, you still had vol pretty elevated, and pockets of even the more liquid markets like Treasuries not acting like they usually do. And so the market, I think, took that in shock, and the easiest answer, especially like the broader markets like the stock market, was to sell, because if you're seeing things that should work and they're not working, your gut reaction is, hey, I got to de-risk and and really try to figure out what's going on here. I think with time and the amount of what's been thrown at this thing, they'll get their arms around it soon enough. Treasury vol has been coming down. We still have elevated VIX, but we're seeing it start to percolate through. But they need to go big, because these are very imprecise tools to begin with, right? There's some pipes are clogged somewhere, and they're trying to flood it and hoping that it just kind of breaks free that log jam to kind of get towards the financial actors that need that help.
So it sounds to me as though because the Fed, in your words, has gotten better at this and came in a little bit earlier this time, like they're being preemptive in what they were seeing. Do you think that's a big reason why we saw the markets react the way they did? And does that mean because they've gotten better at it, that it's just going to take a little bit of time and everyone has to be patient, but it is the right things that they've done?
I guess it is shocking to see this sort of programs and the speed and the size of all this liquidity that's being thrown at trying to fix this. And what are they really trying to fix? They're trying to fix some imbalances in trades that were built up over nearly a decade of easy money that depended on liquidity, and liquidity became very dear. And now they're trying to make sure that market functioning, especially in the treasury market, in the mortgage market, if you kind of work your way from the bottoms up, they're really trying to make sure that that's functioning properly. The repo markets, the money markets, get all that operating normally so that liquidity can actually find its way to where it's needed. I think the market was surprised and shocked, but it was the right move. And even though we saw heightened volatility and some down some down drafts and pricing that would not have seemed logical considering how much they're trying to support. I mean, it was really just positioning relative to how fast can the Fed get involved to support those markets. And that gap of timing and liquidity that wasn't there, created, just uneconomic trades that unfortunately happened. They are reality. They're in the price. You see it in the Treasury futures versus cash bonds. You see it in how credit traded. You saw how equities were opening up limit down even with all this Fed support. And people had to just kind of get a better handle on where their risks were. Their vol adjusted returns went haywire, and they had to pull back. Now going forward, I don't think that they want to become the market. I think they want to be the lender of last resort and keep things functioning until we get a better foundation. But what I think the ultimate goal, and which we can kind of go over more later, their ultimate goal is to provide breathing room so that markets can then figure out what is fair value on a whole host of different factors. And so it's going to be like a pit stop and to figure out, okay, hey, look, the economic environment is different. Now I have to reprice to that new environment. I shouldn't do that when there's just fire sales taking place.
Hey everybody, a quick pause here to talk about FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 Index Futures Contract, symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com. All of the traders listening to this have heard the phrase, don't fight the Fed. Do you think that's still the case, or do you think it is different this time?
I think when you're faced with what we're dealing with and not knowing what the other side looks like and how the economies are going to have to evolve and change, I think that this is no longer about fighting the Fed. This is more about, just rebalancing your views. And the Fed has done this in every single easing cycle. What's different now is that they're using new tools that we're not used to, or that just kind of are just unprecedented in size and scope. But in every single easing cycle, as we head into a recession or a really sharp correction, all they do is kind of slow down that kind of activity. And so I feel like it's not about fighting the Fed. It's trying to understand where they're trying to let things kind of get to, and then and then we're going to all have to kind of step up and realize how much risk taking do we want to take? Do we want to fade that? It's more about fading the macro than it is about fading the Fed.
I want to move on and talk about the dollar and going through your Twitter stream. And basically you're saying that right now we have a dollar curse and a blessing. Explain that thought.
Well, I mean, partly by design and partly by how we got to where we are now. I mean, the dollar is the reserve currency. It's also the critical means of exchange. The last 20 years, especially, but it's been happening since the 1970s. We are increasingly seeing an onshore versus an offshore dollar market, and with that comes different issues to deal with. The U.S. plumbing and the U.S. banking system is complicated enough, but it's much easier to trace and to understand who the actors are and how they interact. But with this, offshore market, the euro dollar market and really the Asia dollar market, there's a lot of other transactions that are taking place outside of what the Fed really has direct purview over. And at times, they'll make assumptions like we all do. And one of the assumptions probably, most likely is, hey, oil is going to trade at XYZ value. And when it doesn't trade like that any longer, those countries are going to be short dollars based on their future kind of obligations of whatever debt they may have taken out or any kind of promises that they made to their people. So, I mean, the same thing is true for any commodity, quite frankly, that's denominated in dollars, or any finished good or semi-finished good that trades, and gets settled in dollars. There's a shortage of dollars from that point of view, and we're also rethinking what the global economy is going to look like when we get through on the other side. So there's a shortfall there. And then there's also a lot of lending that's been done because of the low rate environment that we've been in. U.S. investors, they were chasing yield in emerging market debt. A lot of it, some of it was issued in dollars. I mean, a lot of it's issued in dollars, and and that money, it went overseas, but it was U.S. dollars. And now, are those bonds money good? Are they going? Are those emerging markets going to be able to actually service that debt? And and if they have to find dollars, some of them have built up over the years, like war chests of dollars in their FX reserves by these foreign central banks. Do they have to sell those treasuries and regain those dollars to pay back their debt. So it's a very complicated, onshore, offshore story. It's a blessing, obviously, because it does afford the U.S. a lot of power, and it does, enhance the medium of exchange because you just have one common unit. But it does come with, some negatives, which is when people are de-risking and they're in fear kind of is in the streets, everyone rushes to the dollar. And so the dollar goes bid, the commodities go down in price, and then you end up with a big gap, and filling that gap is not that easy. I mean, the Fed now has opened up swap lines with central banks all around the world. This past week, I think they used about $200 billion. During 2008, 2009, it got as high as $600 billion. I kind of size it up that if it really got bad enough, they can probably borrow, use or tap it to the tune of like 1.5 to 2 trillion. These are really big numbers, and you're kind of really stretching the mandate of the Fed to kind of becoming like the global central bank at that point. So I mean, the dollar, curse and a blessing. I think when we get out of this, it's going to be interesting to see how people rethink the dollar's role in the world. But for now, it is kind of holding things back. It does have impacts on equity valuations from the other side, from translation and things like that. But it's really more the plumbing that I focus on, and it's a dollarized world, but it comes at a cost.
I want to take it to the trader side a little bit. I know that you're not actively trading dollar futures, but knowing the macro side of things like you do and you just explained to all of us. When I looked at the chart of the dollar, it's something I'm looking at all the time. We basically went from 94 to 104, and we're back down to just below $99. So basically, we're sitting right in the middle of this big range that we just had. So, and I think it's at a very interesting point right now because let's face it could start to sway one way or the other, and you have a lot of people that I watch that are really bullish the dollar. With everything that you just said, it sounds as though to me that you are saying that, correct me if I'm wrong, that the macro for the dollar, even though we've seen this decent pullback in it, is still bullish or not.
I would lean more on the bullish in the short run. I mean, I think because of the speed, again, everything's about speed right now, right? And
yes.
we want to, and look, I look at the charts too. Don't get me wrong. I'm not actively trading the dollar, but I watch it to kind of give me signals. And, short run versus long run. I mean, long run, the dollar should go down considering what still lies ahead. But in the short run, I would not be short the dollar. I mean, that's my personal view. It's not anything more than that. But everything that I look at, and it's still unresolved. And we would like to think that there's like perfect solutions for everything, but there's not. So by the time the dollars actually get the needs of those that are short dollars get actually filled, they might still see another up leg, right? So people that are either short dollars actually from a trading perspective and or from like an actual production perspective, these emerging markets and stuff, by the time they actually get enough dollars to feel like, hey, that they're good, the dollar probably still goes up.
No, that's a big help. So what you're saying is that in the short term, everything that you're seeing on the macro side of things is telling you that the pressure is going to be to the upside. So the pressure is going to be on the shorts, or the market, the dollar still has potential to rally from here based on what you're seeing in the shorter term. But on the longer term, you could see the dollar going back down.
Oh, yes, and in a very big way. I mean, it would be in the best interest of, I think, of most people if the dollar actually goes down. So the fact that everyone's kind of like, you're kind of crying for it, it's like, yeah, the dollar has to be weaker, the dollar has to be weaker. The contrarian in me, plus all the macro that I see and how the charts look like, I mean, anything can happen. We can even see even larger, Fed support and even more flooding, and maybe that will take it, what's necessary to make it break. But until then, I mean, being short the dollar doesn't make sense.
So let's talk about gold now, because, I don't actively trade gold on a regular basis. I did this past week a little bit, but if I'm trading gold, I'm always keeping an eye on the dollar. I'm keeping an eye on both at all times anyway, but I'm curious, saying what you said about the dollar, what are your thoughts on gold?
So this is where the long-term part comes in on the dollar, right? And it's one where I don't think the two have to necessarily be at odds with one another. Again, this is short-term versus long-term. The dollar short-term should be bullish. Long-term, if everything works out well, it should enter into a down phase, and that would be very supportive for precious metals like gold. So, I do think that in the like worst case scenarios, like that the gold can have like multiple figures higher, and it's just because it's the one common unit that everyone can kind of go back to. So I mean, personally speaking, I think gold probably makes sense as a long-term play, but trading it day to day, I don't do that. I don't do that. So I think that gold, based on what we've seen throughout history and what we've seen with how governments kind of tackle problems after one after the other, you should see precious metals and things that are in like limited supply go up in value.
It's interesting because I think when I hear you talk about everything that's going on, it's almost like a scenario where we could see the dollar go up in the short term from here, and gold may not get hit as much, or it may even rally with it. I think that would be interesting to see.
Oh, look, I mean, we're in uncharted territories, right? I mean, we're going to see some weird breakdowns and correlations, and that's why
Yeah.
I'm a macro fundamental guy, fundamental based kind of guy, but I'm also watching positioning and flow, and then the technicals, and you try to marry the three, but there's regime shifts, and if we're I feel like we're in a regime shift, or at least we're trying to figure out which direction we're going to next. In those environments, you can kind of have weird things take place like that.
Yeah, I mean, this is why I do macro homework like this, because if you do start to see that correlation breakdown, I mean, let's face it, the last several days, gold has screamed higher, dollar has screamed lower. I mentioned that the dollar is basically, for those FIB people, halfway back, but it's just something just to keep in mind. You're thinking to yourself, this is an important area for the dollar. What if they do start both going up together? So it's something that just by hearing you, that's not something that it wouldn't surprise me as a day trader. So it's just something to keep in mind. I want to, and thank you for that info. I want to move on and talk about Treasuries now. Now that's something that really prior to what's been happening now with the coronavirus, I actually talked to you about this before we started to talk today, was how I was primarily trading Treasuries. I was trading 10-year and 10-year Ultra futures, even over the S&P for the past few years. And that has shifted for me. During this coronavirus time, I've been trading S&P almost solely. So because of what I've been seeing in the Treasury markets, it's been something that I don't even know what to say. I just never seen anything like it. And it's just been very difficult with the less amount of liquidity that we've seen in the past. What are your thoughts on Treasury market dynamics right now?
There's a lot going on there as well. I always characterize the Treasury market as the last line of defense. You need to have stability there before anything else. But the bond market has been, up until recently, at least still signaling and being able to predict the downturn. Everyone was kind of fading it. Oh, bond markets are so heavily intervened by central banks; they're not giving us any good signal any longer, and therefore we can't trust them. The bond market, the curve, basically forecasted that we're gonna go into a slowdown. Of course, it didn't forecast the virus. Nobody really did. But it forecasted that we're at a really dangerous point that doesn't take much to kind of push us over the edge, and the bond market was right. I mean, I say this tongue in cheek. I mean, the bond market has been practicing what we're all learning to do now, which is like social distance itself from other risk assets. But even by trying to, operate in its own kind of dimension, it gets caught up in liquidity traps like we saw in the last 2-3 weeks. So, the bond market, I think it's gonna, it's getting there. I mean, for goodness sakes, I mean, the Fed is buying so much of it that it's providing, a way to get out of positions, and especially on the runs and the off the runs, and that should help out, cash versus futures and things like that. But we're at an interesting point where the Fed, like as I described earlier about the central bank action, they need to not overdo it either. I mean, they need the markets to kind of find its own footing. And I'm an '80s guy, and I love watching old movies, and saw Spaceballs, and it just reminded me of that one scene in Spaceballs when Mega Maid comes in and sucks out all the oxygen from the planet, and then they realize, wait, it's too much. You got to push it back in. I mean, it's the same thing with the Fed buying. They're just buying way too many bonds. They run the risk of collateral being, which is the oxygen of the system, being sucked out too, and then that causes other issues. So I think the bond market it's getting there, and I think that we'll start to be able to get more signal from the charts as well in the coming weeks. Then the question is, are we going to start to trade like how Japanese rates and how European rates trade, which is flirting next to zero?
Hey everybody, I want to take a quick pause and talk about RJO Futures. They are a long-standing brokerage firm with personal broker relationships to learn, discuss, and trade the futures markets. To learn more about RJO Futures, please visit rjofutures.com. Yeah, I could say that even this week, I dipped my toe back and just did a little bit more in the treasury markets. I'm noticing that things are getting a little bit thicker in the book. And that really takes me to the next question I have, and that's about credit markets, because I'm the first to admit this is not my not my strong suit. It's like I understand them, but there's just so much. It goes so deep that I'm always learning more and more about it. What are you seeing right now for credit markets?
So if treasuries matter the most to everything, which I do believe that's the case, then credit is just alongside it. I mean, credit is so important to the banking system and to just getting liquidity flowing through the economy, that it's really where the rubber meets the road. I mean, credit is super critical. And now what has happened, it's another one of those examples that we've had for over a decade. A lot of easy money chasing higher yields in both credit and in high yield and in emerging markets. And they really believed that spreads were going to be stable and that they were going to be like that forever, because this idea that you can get out of these trades in the same way they can get into them was truly tested. I mean, we saw, or as reported by Bloomberg at least, I mean, the largest outflows from bond funds in the last 2 or 3 weeks, and I mean, and then record inflows into government funds. I mean, there's a preference for cash and liquidity, and that means that it comes at the expense of how credit trades. I mean, credit IG, I think from what I can tell from ICE Bank of America OES spreads that are on the Fred database, they got as high as 400 basis points. I mean, the average last year was about 100-ish, so almost 4 times more. They've kind of come back in here. I mean, the Fed now has, as I said earlier, it created a new program that's targeting the investment grade universe, but it kind of leaves other credit out in the cold, and it runs the risk of bifurcating the credit market, where you have the riskier credits like junk or high yield. They're exposed to both the Fed's not supporting them directly, and if we're heading into an economic downturn, defaults start to pick up, and plus, given that some parts of the countries are on lockdown, you can start to see actual cash flow kind of issues. So I mean, the credit market is won't come back as quickly as the treasury market will. I mean, they're going to have more instances of higher vol as we get through the next couple of weeks, next couple of months. I think that's probably the most important. It's probably more important than the equity market, to be honest. If we can't get credit under control, then equities are not going to find a footing at all. And so really, credit is going to be the main focal point for me. Watching the flows, watching how the Fed is involved, and then and how the corporates manage this environment of less cash flows coming in.
You say you're going to be watching the credit markets. Can you just dumb it down for us and say these are the charts or the things that you'll be looking at that give you insight as to what's happening in the credit markets?
I mean, I think you could. I mean, it's a free resource, and I've actually been using it. I think it's great. So, I mean, for your listeners and viewers that don't have direct access to credit data, I mean, the Fred St. Louis Fed database has a lot of good tickers up there. So I just watch the spreads and we see how they're reacting. I mean, you can't use technical analysis on them like you would on yields and things like that. But I mean, you just want to make sure that they are not making new highs, or if they are, how do they compare relative to 2008, or for the energy sector, how does it compare to 2016? When oil was going through its rough patch, and energy names were coming under pressure. So I'm doing really just simple relative analysis to the past, and that's something that I like to do. And one of the things I feel like gives you perspective is pattern recognition and trying to understand how does this compare to the past, and is it how much further could it go, and if it does go to another level, what would it take? And so I'm just watching the spreads versus history versus the averages, and then the flows, which if you kind of just search for it online, you can kind of get a sense from our bond funds starting to see inflows come back in. That would be a healthy sign.
I'm going to ask you a favor. If you could, please just give me a link or two that I could put in the post for a resource for everybody listening to this. So if you go to futuresradioshow.com, in the post that I have here for George's interview, I'll put some links in there for some resources for you guys. George, I want to move on and talk about some of the things you've been putting on Twitter. You actually just talked about how you did do some comparisons, and really, that's one of the things that when I've been looking at your Twitter feed have been really interesting to look at. And actually, your pinned tweet right now as we record here on Saturday, you talked about weeks equals months comparison. History doesn't have to repeat, and policymakers are surely trying to prevent it, but it can rhyme. In a continuation of the prior two charts, below I blend them, but compare weekly versus monthly data. If we track 0809, the bottom is still at least a month away. And I'm going to put this tweet, and actually the tweet that you tweeted on March 15th, which is a long thread. It was recapping that week of events since 2018 in the post as well for everybody to go and see. But just talk to us about this latest comparison that I just talked about.
It dawned on me, and things are moving so much quicker. I mean, the common theme, I guess, for our podcast so far has been about speed and size, right? That's been all about speed. And I'm like, this is just happening way too quick. And I'm trying to keep track of it all and trying to compare it to, what I personally experienced in the last 20 plus years. And nothing really fits. And so I started to think if days feel like weeks, and if weeks feel like months, let me try to just kind of, compare that as a way to see, how much further can we go? And it was really nothing more, scientific than that. It was more about, look, we've seen a pretty big correction in the equity space. We saw an attempt this past week. Who knows if it's a viable attempt to kind of rebound from it. I still think there's more downside to go because we don't really know the full scope of what this is going to do to our economy and how many, unfortunately, people are going to get sick. And so it's those headlines are still out there, and it's going to be weighing on the psyche of markets for the next couple of weeks. So the way everything lined up, that if we are experiencing a kind of cathartic moment of just kind of cleaning up positioning, and people haven't really thrown in the towel yet, because there's still a lot of folks that come in and say, hey, you got to buy the dip because there's all this easy money in the system. True, but it doesn't have to necessarily make its way all into equities first. It can actually just be used for for cash needs and things like that. And plus, cash is in high demand at this point. So, bottom line to me is that, because I kind of blended those two charts together, both the current experience versus what we saw in 2008, 2009, it came up with the kind of very simple assessment that, hey, we probably got at least 20 or 30% more in downside from where we are based on, Thursday's levels.
Yeah, that was an interesting chart. Like I said, everybody, I'm going to put that in the post so you can check that out on futuresradioshow.com, or of course go and follow and check out George's stuff on Twitter. George, a couple things before we get into rapid fire. Give us looking at it through the macro lens, the best and worst case scenarios that you see from this point going forward.
Yeah, so I'm gonna start. I've been kind of thinking about how to best say this, and I've kind of using another kind of old movie analogy, like the good, the bad, and the ugly. I mean, I'll start off with the good, and then we'll kind of work our way through it. I mean, on the good side, I mean, we are seeing people taking this much more seriously. We're seeing even, I think, recently an approval for a quicker test for COVID-19. The faster we get our arms around this, and we know how to trace back where where some of these these outbreaks came from, we're going to get more confidence that, hey, we got this under control. The federal side and fiscal support is massive. Fed's doing all the things we discussed, and it's gonna be a pretty sharp, verging on depression based on the sort of numbers that are being forecasted by many economists in Q2 and maybe even spill into Q3. But we should come out pretty strong on the other side, and that's like the whole V-shaped recovery that by September people can go back to kids can go back to school, people can feel a sense of normalcy, and that's something that everyone's kind of really hoping for, that we get our arms around this quickly. It might linger into May, June, July, and then both whether more we learn about this and get our arms around it and provide support, we'll get to a better place in the fourth quarter, and then we can kind of work towards recovery. I mean, the bad is all of what I described is definitely doable. It's just lining it up perfectly, and so the bad part is that, hey, this just takes time, and that we're going to probably get everything that the good scenario has, but it's going to be dragged out longer. It's just going to take longer to come to those points. It's probably going to need another. I hope it doesn't get this bad, but it's probably going to need another fiscal package. I mean, I think that the $2 trillion that was done is probably a down payment. A lot of it was kind of earmarked more towards the corporates. I think that the everyday folks are going to be suffering throughout the summer, and I think that we're going to need to see another package. I'm a laissez-faire business kind of business capitalist kind of guy, but we're at a point where you really need to help out the little person and also the municipalities. So I think some sort of support for munis and more support towards everyday Americans, I think probably has to happen again. And we got to get better handle on how to cure this, and eventually get some early reads on if a vaccine is possible. I mean, that's at least gets us into the fourth quarter. So I mean that's the bad scenario. The worst case scenario is obviously that gets dragged out even further, and then you get the boomerang effect and the wave two of like what we saw or what took place in 1919 with the Spanish flu, where you kind of get the second wave kind of comes in and you haven't built up enough herd immunity. But that's the worst case scenario. Hopefully we're learning to be smarter about this than what took place over 100 years ago. But that still is a distinct possibility, and markets cannot price a zero chance that happens. So that's why I feel like there's still downside in risk assets. Still, your credit is going to be wobbly until we get a better handle into the summer, and rates, and treasuries will start to perform like a kind of a flight to quality instrument that like it used to, given all the liquidity that's in place.
Last thought before we get into rapid fire. The debt, the deficit. How worried should we be about this?
Yeah, it's a great question. I think you need to, use your bullets wisely and hit it hard when you need to. I think that's what we're seeing take place right now. But I mean, my personal view, I do think that we started off from a much weaker position than we really had to. I mean, the tax cuts were so late in the cycle, added on to debt that we didn't need. It was fiscally irresponsible, in my humble opinion. Keeping rates too low for too long created a credit dependency amongst a lot of different, financial actors as well as the government. And, there'll be a price to pay at some point, and the price will be in the form of inflation and a weaker dollar in the years to come.
Give everybody a sense of what you think that inflation would look like.
I mean, in the short run, we're going to see a tug of war between demand shocks and supply shocks, and I think it's going to be random. But I wouldn't be surprised. I'm not going to think we're going to get as bad as the 1970s because we have huge debt loads, but we can have a pretty decent pickup of inflation in the next 3 to 7 years. think the next 18 months, you don't have to worry about it as much. There'll be just random pockets of inflation popping up. But I'm relatively bullish on inflation as an asset class and real assets over the next 10 years.
Yeah, it's going to be interesting to say the least. George, great stuff so far today, man. But we are not done yet. Rapid fire questions next if you're ready for those.
Fire away.
All right, everybody. Our rapid fire segment is sponsored by Trading Technologies. Trade the global markets with TT. They are the world's fastest commercially available futures trading platform. Now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. You can try it now for free at tryttnow.com. George, first question for you. What trader has influenced your life the most and why?
Well, I've been fortunate. I've been able to work on various trading floors and know a lot of traders across the street. So maybe some of them listen to this podcast, hopefully. But there's not one specific trader. And, in reality, the one person that really kind of got me going was a gentleman by the name of Jerry Lucas. He's kind of retired from the business. I learned how the Japanese trade rates, which really gave me tremendous insight over the last 10 years to be able to call the bond market better than I think a lot of other strategists on the street. And really, he also emphasized the fact that you should watch the flows, watch positioning, and learn how to keep track of that. So I would say it was my former mentor, Jerry Lucas, who I worked with at Bank of America.
What was one of the hardest things for you to overcome in strategy recommendations?
I think early on in my career, especially, and I think anyone that's listening to this will know that I was a little bit overzealous at times, and thinking that every trade was possible. When like moments like now, when liquidity just drops, you can't get things done, and so understanding, sizing your trade right and what recommendations make sense for traders and investors to be putting on in the current environment or the whatever environment you're in, and then trading is all about then like risk management and like trying to understand how do you manage that position. That's something that many strategists I think don't understand well.
How has your strategy recommendation process evolved over the years?
So I started out more on the kind of quant side and using signals and trying to understand what the data was telling me, but then the last 5-10 years really married that and coupled it to the macro outlook. And that's what really helped me with the more structural and strategic views. The combination of quant and macro was really important.
What is one attribute that you believe every trader should have?
I think this is true for everyone on this planet. Being humble, because the market and the world around us is much bigger than any one person, and understanding your place in that grand scheme of things will help you better manage risk.
Favorite book about trading?
I've read so many technical books. I've got a whole host of them in my library. I think one that everyone should read, and it's more about the plumbing because it's one of the areas where many folks don't quite understand, and it goes back to the beginning of central banking. Is a book by Walter Baggett, Lombard Street, understanding how the money markets operate. Because once you figure that out, then you can then say, hey, I know why repo is doing what it's doing, and therefore I can size my trades right.
What's the best piece of advice that you received about trading?
This is a cliche, but stick to your stop losses and let your winners run. And it's easier said than done, right?
It sure is. If you could go back in time and give the younger you a piece of advice after everything you've learned about trading in the markets, what would it be?
Is learn what regime you're in and look for signals of when that regime is about to change.
If you had to pick a profession other than working in financial markets, what would it be?
I love speed, and finance it definitely gives you enough of that fill, especially lately, but I would say race car driver.
If you had an elevator pitch me your edge, what would you say?
Is that I've learned not to get married to models. I'm a big believer of positioning and flows, and following the money leads to better trades. And so I think that plus experience is half the battle.
Last question for today, George. Favorite thing to do when you're not working?
I would say this is, for me and my family, it's travel. But given that the world's on hold now, it's all about my hobbies, and I've been trying to keep busy at home. I love to tinker and build things, especially mechanical and electronic doodads, and I'm doing that now with my son because he's home, and all about cars and building things and taking things apart.
George, where can people find you on Twitter, and give us a website to check out?
Sure. It's quite simple, and I'm very fortunate to be able to get this handle because I'm not even sure how. I just only recently started to use to Twitter. It's at Bond Strategist, or just look my name up, George Goncalves. You'll find me on Twitter, and I'm still kind of figuring out my next moves. I'm dropping knowledge on Twitter and focusing on health and family and my hobbies. But I'll think of a business model at some point. But I have a website called thebondstrategist.com as well.
Highly recommend everybody go out there and follow George on Twitter. Like I said, George, I learned a lot from you today. I've learned a lot from you in the time that I've been following you on Twitter. Thank you so much for educating us today and giving us your thoughts on what's happening in the markets. I wish you all the best, my friend, and thank you so much for joining me on Futures Radio Show.
Thanks for having me, Anthony. All the best for you as well, and your listeners.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.